Hi, I apologize for the way I'm dressed. I just got here from Argentina, and yeah. So we're just gonna give you a presentation I've been working on for a little while, as I've been doing a few conferences over the last 2 months, just on exploration trends. And then after that, we will go on to Tinka and talk about their new resource, which we're all excited about, with Fernando. And then you guys can go drinking, and I'm going to go to bed. Okay. Okay, this is basically about junior exploration companies being back in vogue. I only got 10 minutes? I forget it. Drivers of interest in exploration plays, why these things are back in vogue, and then what are producers doing in this environment? And then we'll quickly summarize. So, back in vogue. And so this is, as I've been compiling, every week we get a sub asking me about another company that's up 450%. So every week there's a company that goes up 1,000% almost. So if we take these 16 companies this year in 2017, they've averaged a return of about 664%, up to 4,400% with this new one that someone just mentioned this last week. And the average return was only over 3 months. Anywhere from 1 week to 8 months. So that's the market response right now to the juniors, to exploration stories, which you know, only a few years ago people really wouldn't care. Just like Robert was saying that, hey, we put out this hole and nobody noticed. Now people are noticing, and sometimes you don't even have to put out an assay result. People still notice. Sometimes you don't even need a drill hole, and people notice. Yeah. Anyway, so you know, this is good. I mean, it makes you think the market's really good for certain companies. But you know, the risks remain. So what I showed you was the price to peak, and now what I'm showing you is the peak to current. So as more news comes out, you know, the market will react and it'll jump on to the next one. So that's the volatility you're dealing with right now. So this is an average fall from peak of 39% down to, you know, about 80%. And I mean, for Alvaro, Tinka, because of the resource, they basically are trading at their peak again. So they did 2 peaks. Well done, Alvaro. And so not only is the equity market interested with respect to trading these stocks, but also they're getting funded, which is important. So in terms of looking at funding year to date, I think this is up to September, the financings for majors that are listed, use a proxy as the TSX, have actually gone down. So the bankers are more focused in on the juniors right now and raising capital for them, because they're up about 2/3 year to date in terms of, it's not a lot of money, but this is coming from very minimal money 4 years ago where they didn't have any money. Now, of those same 16 companies, I mean, it's quite a range, but you know, the average cash position is about 14 million, when a lot of these, that would have been their market cap. And so of those 16, you can see the focus is again on gold, copper, that's about 75% of those companies. That's the exposure. But jurisdictions, people are focusing in on these safer jurisdictions. So between, I mean, 60% Australia, Canada, US, Finland, that sort of safe jurisdiction, and Peru is still a country people are keen on. So between those two, you've got 75%. So now let's look at what's driving all this enthusiasm. So I did leave out lithium in terms of some of those plays, but I'm sure there would have been plays in there that would have knocked the lights out as well. But as you can see, between December 2015, December 31st, 2015 to now, the best performing assets, commodities, has been zinc, which has been good for Tinka. I'll try. I got a bet with Alvaro to say Tinka 10 times, and somebody count. I think I'm on 3. Lithium, but look at the peak and then the current. So zinc and lithium and somewhat palladium have held their gains. Silver hasn't. Copper has done well. Lead's done well, but platinum hasn't, and gold's given up a bit. Uranium only came back because of Cameco's announcement this week. Otherwise, it would have been a bigger negative. So you have a multi-commodity force behind a lot of this enthusiasm, which is good. It's not just one commodity. And so if we look at, okay, the equities, how did they do? So the GDXJ has actually done remarkably well in terms of a beta to gold, because it's outperformed gold by about 4 to 5 times. The lithium ETF has done well but it hasn't outperformed the metal or the lithium carbonate. Why? Because if you actually dig into lithium ETF, things like Tesla are actually in it. So if Tesla doesn't perform very well, it'll go down. So the lithium ETF's a bit different in the sense that it more takes a vertically integrated look at lithium exposure, whereas the GDX and the GDXJ and the uranium one and the XBM look at only mining companies. And so what we've seen driving some of this, and we'll take a look at gold, is that we had these big peaks of increase. So that's a 40% compound annual growth rate in this period, and then we had a 44% right up to the peak of about $7 billion spent in gold exploration in 2012. And then we had a dramatic fall from grace of about 20% per year for gold exploration. And what I want to point out as well is because most of the companies I showed you were grassroots explorers. So you can see back from 2003, there was a trend already started that grassroots, in terms of, not absolute, but in terms of relative proportion versus the other types of exploration like brownfields, has been declining since 2003. And then we can see that in the discoveries. There's less discoveries with respect to how much is being produced. We're not filling the pipeline. And then that pipeline results in a decline in reserves. I mean, some of the declines obviously related to the gold price, but the problem right now at these gold price levels, they're not finding quality projects to refill their pipeline. Finding projects that work at $1,500 won't fill their reserves right now, especially since some of them are using $1,200 or less to define reserves. Let's take a look at copper. So copper, you remember I showed you the peak in 2012 for gold exploration was about $7 billion. So copper, they spend just a little bit over $2 billion when it peaked. So it's a dramatic difference in terms of overall exploration. But in grassroots exploration, copper's actually stabilized. But we still had that 4-year 20% plus drop down to 2016. So now let's look at the other side of the ledger and look at what are producers doing about this now. So if I look like at a major gold producer, and I just take one, Barrick, and I use Barrick, and kudos to them. I could find everything on their website with respect to annual reports, so I use them. And so this figure is just looking at the proportion they spend of their revenue on G&A and the proportion they spend on exploration. And exploration, accounting-wise, can change. They sometimes use brownfields within exploration, and sometimes they capitalize it so you don't see it. So there's a bit of volatility there. But you can see when it peaked, they were spending up to 8% of their revenue as a proportion. Now we're talking relative, not absolute right now, on exploration. Super keen. But you can tell there's a trend down to about 2012. G&A, kudos to them, was doing the same thing. But then when they introduced Mr. Thornton as chairman, we had a bit of a peak there. And now it's flattening to about 3%. But right now, we're at a situation where major gold producers, such as Barrick, basically their G&A equals their exploration in terms of a portion of their gross revenue. Is this going to continue? I don't know. But right now, that's an issue for the majors. How much are they willing to spend on exploration, and will it be volatile, or will they just maintain a core of explorationists and continue to look at different ways of adding to their pipeline? If we look at copper, I took Freeport, which used to be Phelps Dodge, which I used to work for, but you can see here that they've basically always had a lower proportion spent on grassroots exploration. They never had the 8% that Barrick had. Their G&A has been accelerating, but we got to remember that it's SG&A, and I worked in the sales department in Phelps Dodge, and we do spend a lot of money in that department because they sell an intermediate product, not a fungible product like gold. So this may be reasonable, but you can see like that's going well below 1%. So what are they doing? So if we just take Beaver Creek, and Beaver Creek is a precious metal summit in Colorado, which has become a great place for juniors to go and get in front of not only institutions, but also in corporate development. And so over the last 2 years, what we've seen is big increases in delegates. The absolute delegates, the most delegates are still the institutional buy side. But the growth has been in corporate development. And I've had lots of stories with juniors going to these conferences, and they'll be flat out with 12 meetings, and half of them will be corporate development. And they might be sitting on one side of the table, 2 of them, and they might have a team of 10 on the other side of the table from a major. Because they're super keen right now on trying to find projects. And so what is that translated into is deals. So now the majors are funding the juniors. Like I used to do this when I worked for Newmont, and we used to take little pieces in companies. But as you can see, there's almost 2 approaches here. There's one approach, like I'm going to split my money between a few projects that I really, really like, or I take the Goldcorp Agnico approach and hit a few companies with a little bit of money. This approach Newmont's taking, and Barrick, is more about let's find specific companies that are working in specific jurisdictions, looking at specific deposits that we're interested in. And this is a lot of private placements by Goldcorp and Agnico. These are more like serious joint ventures where they're actually on the ground helping these people because they want to find something. But for Goldcorp and Agnico, Agnico does spend a lot of money on exploration, but definitely for Goldcorp, who are basically have said that they're out of grassroots exploration, this is probably their proxy for grassroots exploration. Okay, so summary and conclusions. This is going to be quick. So basically, contrary to only a few years ago, junior explorers are being rewarded for their success. So we're talking about the average returns of 600% over 3 months. They're much better funded now with better liquidity. Most of the projects that we've seen that have hit it out of the park, let's say, have been predominantly gold and copper plays in safe jurisdictions, safe meaning mining-friendly jurisdictions. And all this is being underpinned by not only like copper and gold, but multiple commodity rebounds in zinc and lithium. And the equity ETFs have peaked. They've peaked better in gold, but the lithium and base metals ETFs have definitely held their value. And what's another thing underpinning this desire to have more exposure to grassroots exploration companies is that exploration expenditures have been basically falling. They've fallen 20% per year for the last 4 years to 2016. And so there's a lot of pent-up need for exploration, especially the grassroots level. And that's worked against the majors. Now that you have a gold price at about $12.50 and going sideways, they're having a hard time replacing their reserves with quality assets. And they really don't have pipelines. And so they're becoming more and more dependent on juniors for good or bad. And I'll add that another problem that majors have is their issues with respect to environmental health and safety, and some of them cannot do some of the projects that the juniors do. They can't work in those environments. So they almost prefer the juniors do it because they can do it for cheaper. So in conclusion, obviously the level of interest in junior explorers is intense right now, but it continues to be a high-risk sector, and you'll always play it as a lottery ticket because that's what it is. Depending on the commodity, de-risking events now, like technical reports, which wasn't the case for Tinka, do not garner the same level of response as a drill hole even without assays. People are not paying for de-risking events now. They're paying more for upside potential. Just show me one drill hole here and then show me your land package and I'll say it's 100 million ounces. Our focus at Exploration Insights remains on exploration, but we're going to continue to avoid companies that don't pass our fatal flaw filters. And the reason is, in the end, this is a volatile sector, and we'll still seek protection with the quality management teams that we want, advancing high potential assets because we want those things to get taken out. That's our underlying downside protection. But we need jurisdictions, again, that we think these big companies want to be in. And that's it for me. Thank you very much.